There is a massively trending search on permanent rate buy downs right now, and everyone's making videos on it, but almost no one's explaining when a permanent rate buy down actually makes sense. So if you're buying a home, this could actually save or cost you, and we're talking thousands. But before we get into that, I need to break down all the buy down options because most people misunderstand them completely. Everyone's heard of permanent rate buy downs. These are points. Some people will talk about temporary ones too, but technically there's three, and each serve a totally different purpose. So let's start with temporary. Temporary buy downs, maybe you've heard of this, like a 2-1, a 3-2-1 buy down. These will drop your rate for the first few years. So instead of, say, jumping into a 6.5%, you may pay 4.5 the first year, 5.5 the second, and then back to 6.5. When does this make sense? In two situations. One, you're stretched on cash flow for the first few years, or two, you fully expect to refinance before the rate resets. But here's the trap. If rates don't drop and your income doesn't increase, you're now stuck with a payment that you never budgeted for. So you need a clear exit plan or rising income. Now, permanent buy down, points. This is what people think that they're asking about. You pay more upfront, and in exchange, you lower your interest rate over the life of the loan. And that's a very powerful way to save if you stay in the loan long enough. But if you sell or refi in the next few years, you just paid thousands of dollars for a discount you actually didn't end up benefiting from. Also, some people will use gift funds or seller credits to cover this, which helps. But if it was your own money, or if it is your own cash, you have to ask yourself, would this money give me more value somewhere else? Now the third type, most people don't even realize that this is happening most of the time. It's a finance buy down. You roll the cost of the discount directly into the mortgage. And it sounds painless, but there's a trade-off. You're not paying interest on a discount. So the break even takes even longer and the long-term savings will shrink fast. This one's common when lenders advertise a super low rate, but they actually don't tell you that they baked in a huge fee. So you're not just buying the rate, you're actually financing it. And this goes over a lot of people's heads, so watch out for that. But here's the real question you should be asking yourself. Not should I buy down my rate, but how long will I hold this loan and what else could I do with the money? So if, let's say you're staying for 7+ years, a permanent buy down can work. Or if you're planning to refi or sell, a temporary can give you relief. But if you're guessing, stretching, don't let the word buy down distract you from the bigger picture. Sometimes keeping the cash is actually the better move for reserves, remodeling, or maybe that money could actually be accruing interest in some other sort of investment or a high yield savings account. If you run the numbers, you understand the math and your timeline, the right buy down can tilt the whole equation in your favor. And that's not to mention that actually people go the complete opposite direction. If you don't know what I'm talking about, or if you're looking to buy a home but you're short on cash, read my caption or my pinned comment and I'll explain that for you.